Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guests today are Michael Kohik, Director of ETF Product, and Tamara Levin, Senior Municipal Credit Analyst at VanEck. We are talking about municipal bond investing today. Mike and Tamara, welcome to both of you, and thank you for joining us.
Thank you, Nina.
Thanks. Great to be here.
So bonds are back in favor with investors this year, and that is thanks mainly to yields, which are not seen since the financial crisis. And that is why fixed income ETFs, including municipal bond ETFs, have gathered significant inflows this year, because bonds are now considered a viable alternative to stocks. Now, we are focusing on fixed income bonds today, and I wanted to start with a quick primer of municipal bonds. So could you please tell us what exactly are municipal bonds? How big is the market currently? And what are the different kind of issues and issuers? And who are the biggest investors in this space?
I'd love to take this question. Municipal bonds, which we often refer to as munis, are a type of debt issued by states and local governments, from states themselves all the way down to your local school district. And this muni debt can also be borrowed by other public entities and nonprofits like airports, hospitals, and toll roads, and even less glamorous entities like sewer systems. There's about $4 trillion of muni debt outstanding from about 70,000 distinct borrowers. So it's a very diverse sector from a state perspective, from a sector perspective. These bonds are issued for projects that benefit the public on a local or a national level. And continuing on with the idea of who the issuers are, it could be something from a new runway at an airport, a new high school in a growing community, repaving roads, and so on. The biggest investors are individuals, and we see this through personal investment accounts, as well as through mutual funds, ETFs, money market funds, etc.
Thanks. That's a great intro. And so let's talk about the advantages of investing in muni bonds. So we understand that interest on municipal bonds is exempt from federal and sometimes state taxes as well. And probably that is one of the biggest advantages of investing in muni bonds, because those yields on muni bonds, and we mentioned earlier that yields are at levels which were not seen since the financial crisis, and yields on muni bonds, they are even juicier after adjusting for taxes, which are, I think, called taxable equivalent yields. And of course, the higher the tax bracket, the more attractive those muni bonds look. So could you please tell us a little bit more about tax advantages of muni bonds? And are there any other advantages apart from tax advantages of investing in municipal bonds? And are munis suitable only for high net worth investors?
That's a great question, and a lot of nuance in there that I really appreciate you starting with. So yes, municipal bonds do have a federal tax exemption, and sometimes a state and local tax exemption as well. And that does mean that the higher one's tax bracket, the higher the return on the investment. But it doesn't mean that it's only attractive to individuals in the highest tax bracket. As an absolute return, it could still be better than other investments. And the tax exemption is certainly the first attribute to come to mind when considering investing in municipal bonds. But I want to look at it from the other side. It's not just beneficial because it offers a personal tax exemption. The reason that tax exemption is there is to keep borrowing costs down for the entities borrowing the debt. Now, that results in having municipalities owning less debt on an annual basis. They don't have to be paying as much. And that in turn results in increased security in borrowers of this type of debt because their borrowing costs are lower. So the amount they need to pay back every year is lower. Both of these issues combined result in munis being a really great asset for diversification in a well-rounded portfolio. It's a safer asset class. It's less volatile. And the tax exemption, of course, on both sides of the coin, provide a lot of security.
Yeah, and just to build out on that diversification point, Tamara, the extreme low correlation to a lot of other fixed income asset classes and obviously equity asset classes, that's very beneficial to investors who have a diversified portfolio.
Now, let's talk a little bit more about the tax exemption, because recently there have been some talks about the potential end to the federal tax exemption for municipal bonds, particularly because there are so many concerns about surging federal spending. And Tamara, you posted a note recently on VanEck website. It was titled Municipal Bonds and the Tax Tug of War. So please tell us what would happen if municipal bonds lost their federal tax exemption, and if there are any chances that they would lose this exemption anytime soon.
So while the tax exemption cannot be taken for granted, we don't anticipate munis losing that exemption right now. For one, it's a very small portion of the federal budget. It's 4.5% of the federal budget gap itself. And it's a very large benefit to government borrowers. So these borrowers are in every state, which makes it a bipartisan issue and less likely to get hung up in Congress. In the unlikely event that muni bonds did lose their exemption, the change wouldn't impact bonds that are currently outstanding. We believe it would only impact bonds that have yet to be issued. So current bonds you would not have to worry about current bonds you hold all of a sudden becoming taxable.
Tamara, this is a favorite topic that comes up in Congress from time to time. Could you talk a little bit more about the discussions we've had on that?
It often comes up, and as we spoke before about the tax exemption being seen initially as a benefit to the wealthiest Americans, those with the highest tax bracket, constantly there's re-education occurring towards people who working on the Hill. Lobbyists are always educating legislative staffers. You have to remember that the turnover in the Hill is very fast. You're talking about every 2 years, every 4 years. So the need to constantly educate people on the other benefits of the tax exemption, particularly for borrowers, for that local government, for that sewer system, to ensure that they have access to the markets on an affordable rate. That's the side that lobbyists are constantly providing. That's the perspective that lobbyists are constantly providing to ensure that all the new staffers are up to date and understand the bigger issues here.
So we understand that there's so many concerns about the federal government's finances currently, and in fact, Fitch Ratings downgraded the U.S. government's credit rating, warning about the growing debt burden and also political dysfunction in Washington. So what about the health of these municipalities? How do their finances look as of now? And I understand that there are also concerns about the lack of transparency, because it seems that filings reporting by municipalities, they remain stuck in the last century. They file reports very erratically, different formats, so they are very difficult to read. So could you tell us a little bit about the current state of finances in this space?
Municipal filings have had a history of being very outdated and incomplete. We have seen significant improvement there, but you are correct. The issues are still present, and we usually stay away from we usually avoid any credits that do not have sufficient disclosure. If we cannot know any of the important metrics, how much debt there is, how revenues have increased or decreased in a year, or even in a quarter, depending on the sector, we will avoid those. We cannot evaluate something without the information to measure the risk.
That's good to know. So can states surpass the US government in credit ratings? And I saw a recent note by you. So could you tell a little bit about that? And a second part to that question is that which are the best and worst rated states currently? Because we are here in Chicago, and I know that my state, Illinois, is one of the worst rated ones. So I was just curious to know about the best and worst rated states.
Sure. So I believe first that it is fair for muni credit ratings to pierce that federal government ceiling rating. It's because the debt is completely different, and it's also supported by different laws, from federal laws versus state laws. And the security is also completely different. So on a municipal bond, you'll see that they're secured by a specific revenue, whether it's a local tax revenue, tolls on that highway that you're driving on, sales tax, a property tax for that school district, and even college tuition can cover some municipal debt. So these are very different from federal treasuries and how those are made up. Municipal bond issuances also typically have tangible results and are not for cash flow like much of the federal debt. So you issue those bonds, a few years later, you are going to see that road paved. You are going to see the new buildings, the new runway for that airport. So state and muni issued debt are very different credits from the US government, and the rating cap should not impact munis. As for the best and worst rated states, I don't want to point out names, but really when we look at any credit, and this comes up for states certainly, we evaluate them by flexibility and willingness. So what is the flexibility to increase taxes or cut expenses, increase any revenues if there is a cap on how much a certain revenue stream can be increased? That is going to be less favorable to that state. And along with that goes the willingness. What is the willingness of the legislature, in this case, in Illinois, to raise the income tax? That was a problem for quite a few years for Illinois, and still some would opine that the tax rate isn't quite as high as might be needed. So while the tax exemption on muni debt has a profoundly strong benefit to the borrowers, right now it accounts for only 2.5% of the budget gap itself. So its removal won't drastically alter the federal fiscal landscape.
Very interesting. So now let's talk about the best opportunities in this space. And it appears that bonds are now headed for a record third consecutive annual decline, and that is led by losses mainly in longer duration bonds because of the aggressive rate hikes by the Fed. So looking at the opportunities now, some experts believe that the Federal Reserve is near the end of its cycle of interest rate hikes, and it is the right time to extend duration to lock in those high rates. Whereas some other bond experts, including bond guru Jeff Gundlach, he said recently that it's T-bill and chill time for bond investors. So he recommends investing in the shorter, ultra-short bond ETFs. Municipal bonds, they have certain more nuances in addition to Fed's rate hikes. So tell us, where do you see the best opportunities in this space?
Yeah, Nina, you're absolutely right. We've come off a year and a half of unprecedented actions by the Fed to tame inflation and cool the economy. So that's created an extreme amount of volatility that we've seen in the markets, including in municipals. Bond investors, from what we've been looking at, seem to prefer investment grade exposure over high yield, and that's just based on looking at fund flows this year in particular. Where they're going specifically, it's kind of a mixed bag. So we've seen the yield curve steepen, and investors seem to be buying where yields are most attractive. So that is, as you've said, now that we've hit a pause in the longer end of the curve, or even in the intermediate part of the municipal yield curve. Intermediates has been where the curve has historically been the steepest, and investors, based on fund flows again this year, seem to have the strongest preference for that part of the yield curve. So not short and not super far out, long, 30 plus years. What's interesting is the strongest performance has been in the short end of the curve this year, year to date. So short duration focused ETFs have been the beneficiary of the strongest positive performance so far in 2023. The short end of the curve can be a really good place for investors looking for attractive income levels without taking on extra duration risk. So that's the risk when rates rise, the value of your bonds are less. The reason why the short end of the curve may be attractive for those looking to keep duration in check is that we've had a persistently inverted yield curve at the short end of the curve that I believe began last year, and it's been persistent through this year. So that means that yields at the short end, 1 to 3 to 5 years, are higher than maybe where you see in 6 and 7 years. So with the positive performance we've seen in the flows, we've seen investors have been paying attention to that opportunity. It seems like investors took a pause kind of in the month of September, and as we've moved into October here, and that's not unusual. Those are usually very weak months in the municipal sector, but there's a seasonality of strong reinvestment demand that happens at year end, typically December into January. And so if the investors are looking to deploy cash and take advantage of these yields, like you've said, we've not seen in almost 10 or 10 plus years, munis can be a really great place. Picking where you want to be in the investment grade section of the yield curve, that's always a question that investors have to kind of consider in terms of where they want to take on duration risk or not take on duration risks. But there are very attractive yields in throughout the yield curve. Again, it's steeper than what it had been earlier in the year. That steepening took place kind of in the last couple of days here as munis followed treasuries. So I think investors would do really well to potentially look at this time to take advantage of these yields and deploy cash either in the short end if duration is a concern, or take those even higher yields out in the long end.
Great. So VanEck offers a nice suite of municipal bond ETFs. I understand you offer 8 different kinds of municipal bond ETFs. So could you talk about some of those ETFs that are seeing a lot of interest from investors this year?
Yeah, absolutely. VanEck has a suite of several ETFs. We segment the investment yield curve like it's typically done throughout the market, whether it's a mutual fund or an ETF complex. We offer a short duration, an intermediate duration, and a long duration investment grade offering in the ETF space. Our approach to the yield curve is a little different than what you might see in some of our competitors or in the more traditional mutual funds, where we decided when we were working with our index provider to design these indexes, we took larger parts of each of those portions of the yield curve. So our short fund is 1 to 6 years until maturity, or actually 0 to 6 years to final maturity. Our intermediate fund focuses in on 7 to 17 years to maturity, and our long is 17 plus. So again, they're all investment grade portfolios, so fairly safe in terms of credit quality or your credit risk exposure. But by taking larger portions of each of these sections of the yield curve, we're trying to maximize the yield that investors can take if they decide to deploy cash or take an investment in any one of those sections of the curve. We also offer 2 ETFs in the high yield space. One is a short duration focus, a shorter duration focus, and the other one is the whole market, an aggregate approach. So those tickers, the aggregate, the whole market is HYD, and the short duration is SHYD. So it's the same kind of premise as in the investment grade. So if you want high yield exposure, but you want to take on less duration risk, you're going to take SHYD. If you want the whole market approach, where you believe maybe where we are right now, rates are benign, we're going to stay longer for higher for longer, but there may not be any further rate hikes or action by the Fed, at least in the short term. Taking the whole market approach could make sense. We also offer an ETF of municipal bond closed-end funds. So it has a smart weighting mechanism built into its index construction where it overweights the closed-end funds trading at larger discounts to their NAV, and it underweights the closed-end funds trading at premiums to NAV. And that has, in effect, a buy low, sell high kind of mechanism built into the rebalance of the index itself and therefore the portfolio. Also with that portfolio, with that ETF, you're getting yields that are very similar to buying high yield or below investment grade bonds, but those portfolios of bonds and the closed-end funds are primarily investment grade. They typically get their yield enhancement through the use of leverage by the active managers who manage that fund. But there's also a yield enhancing component by buying the closed-end funds at a discount to their NAV. Lastly, we do have one more. It's a sustainability focused or an ESG focused Muni ETF. We have a partnership with HIP Investor, who's been doing ESG, SDG, climate threat resilience ratings on municipal bonds and municipal bond issuers for 15 plus years. So they have incredible amounts of experience and information that they catalog, and we run that fund specifically against HIP screens for ESG, SDGs 9, 11, and 12, opportunity zones, so investment in low-income areas of an issuer's geography, as well as climate threat resilience. So how prepared are the issuers for future climate risks to their geography?
Very interesting, Sweet. So I wanted to discuss a little bit about the role of municipal bonds in an investor's portfolio. So we talked about advantages earlier, diversification benefits, relative safety, and then tax advantages, which result in a very juicy income yield. So how much of an investor's portfolio should be in municipal bond ETFs in your view?
Well, that's an interesting question. We always hope that investors defer to wherever they get their financial advice from, whether it's a financial advisor or some other location. I don't have an exact percentage that investors should have their overall portfolio allocated to municipal bonds, but we definitely do feel that it's an important component for the reasons that you outline. A super great diversifier in terms of low correlation to other asset classes. Typically, lower volatility than what you would see in taxable bonds and or especially stocks. So again, that diversification benefit. And the tax benefit can't be ignored for investors across every tax bracket because like we've kind of laid out, for an investor investing in municipal bonds, they have to find a taxable investment at the federal level that's yielding as high as the taxable equivalent rate of that muni bond. So, for example, our short investment grade portfolio SCMB, its yield to maturity is 3.86%. A 5-year Treasury right now is 4.59%. So we'll just use the highest tax bracket just for example at this point. That would mean that Treasury bond would have to yield 6.13% to match the after-tax yield of the muni portfolio. So tax exemption, diversification, typical low volatility or a volatility damper for your overall portfolio.
I totally agree with Michael there. I think that often people consider their age where they are in their investments when they decide how much of their portfolio should be in munis. But I also think it's important as a diversifier, I think often of munis as a safer asset class and again, less volatile. And that portion of your portfolio allows you to take the risk level you're comfortable with the rest of your portfolio, almost as if it's a barbell. It should help balance out the risk that you're taking elsewhere.
Great stuff. We'll have to leave it there. Michael and Tamara, thank you so much for joining us today and for sharing your insights.
Thank you, Nina.
You.
Hope you enjoyed the conversation with Michael Kohik and Tamara Levin of VanEck. Now, let's recap some of the ETF tickers that we discussed on the show. So if you want to invest in short duration muni bond ETFs, the ticker symbol that we discussed is SCMB. And if you want to extend your duration a little bit to take advantage of these high yields, then the ETF is ITM, which invests in investment grade intermediate term muni bonds. Michael also mentioned a fund of funds. The ticker symbol there is XMPT. Now, if you want to look at other municipal bond ETFs, the most popular ETF in this space is by iShares. It is the iShares National Muni Bond ETF. The ticker symbol is MUB. And the cheapest in this space is by Schwab. The ticker symbol is SCMB. It is the Schwab Municipal Bond ETF. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.